Hi, this is Dante with Dante's Pro Tips. Thank you for joining me today. Today we're going to be discussing one of the top 100 pro tips that I've used in the past that many people have never heard of. This is pro tip number 37. Today we're going to be discussing the ins and outs and the benefits and maybe the detriments of using the gifted equity. Now, before we go too far on the gift of equity, I'd like you to press like and subscribe so you can get more of my content, and it'll help me keep doing this for y'all. Let's get right down to it. So when we're talking about gift of equity, we're basically talking about when you're buying a property or you're selling a property and there's a equity amount that's not being used for one reason or another that'll be transferring from the seller to the buyer. Now, this typically requires some fundamental rules to be in place for this to be used and valued properly. I also strongly encourage you to get with your own CPA and discuss all the ins and outs. Even though I've done this a ton of times and had it underwritten closed many times, I do preface it by A, getting with CPA, and B, you've got to find the right lender that's going to be able to do these things correctly and make sure it works out for you. But in a perfect world, there will be a time in your life or a time in your client's life where there may be an ability to purchase a property from a close or distant relative. This could be done on purpose, structured this way to be planned out in the future. An example of that would be is that you're gonna give your house to your son when you get older, and at some point in time he's earned it and he's gonna purchase it from you because maybe there's still a loan on it, and he's gonna get his own loan to buy it, and you're gonna give him maybe a parent discount or give it to him just at what you owe on it. There's a variety of different concepts that come into play. Typically, the normal call that I would get is, hey, I've been renting my house from my grandma, for a long time now. And she says I can buy it whenever I'm ready. I just don't have the right credit to be able to get approved. I don't have any down payment. The property needs repairs. She's willing to give it to me at a discount, but she doesn't have any money to fix it up. She doesn't have money to, pay my closing costs. What do I do? Well, let's start with some of the parameters again. So the first parameter is the relative has to be selling to another relative. So this can be difficult. Proving the relatives are related is somewhat abstract depending on the underwriting. Oftentimes just a letter stating that someone's related has been useful. I'm assuming that at some point in the future, underwriters or somebody will ask for more proof, but I'm not sure exactly how far down and how much proof they will go to. I guess it depends on each underwriter. But let's just say that there is a relation there that's been formed. Then that's one requirement. The second requirement to use this properly is to, and when I say properly, I mean as part of the contract. There's other ways, which we'll get to at the end. But the proper way would be if the seller is selling the property and that new buyer is going to own or occupy it, which means move into it and live in it, or own it as a second home, which means have it as like a vacation where they visit and see family. They're in it at least a quarter of the time. Typically, a second home or vacation home would have to be a certain mile distance depending on the rules at that time, but let's just say right now I believe its FHA rule is like 45 miles away, something like that. But either way, you'll look up the rules, your lender will look up the rules, you'll make sure you're on point if you're going for the second home situation. And it doesn't work for VA loans for some reason, and it doesn't work for jumbo loans. And just so you know, VA loans is a veteran-backed loan, military. Someone's in the military, they may have still be in the military, or they may have been honorably discharged, but they're able to buy a home and have it backed by guaranteed basically by the VA that helps them get into the home. Well, that one's not going to allow the gift equity, which I'll tell you why that shouldn't be needed anyway, but it's fine to know. And then the other one is the jumbo loans. The jumbo loan basically is for loan sizes that are above the normal loan limit. These ones are non-conforming, so that doesn't work with a lot of these rules. Usually when I say non-conforming, it means unusual something different, something that not everybody's willing to do. Conforming will be a typical or normal situation. So for example, a lot of condos might have to go non-conforming, especially if they're in high rises and they're mainly rentals or vacation spots, stuff like that. Mixed use sometimes has to go non-conforming, commercial property, obviously, stuff like that. So there's a lot of different things that you'll get and delve into later, but right now we're just focused on the gift of equity. So let's go over the benefit right now. So the first benefit that we want to really look at, it's the easy one, is when this contract's written, if a buyer doesn't have their down payment, they can get it gifted. Okay, so let's walk ourselves through that. So writing a contract, let's say that a home is worth $100,000 and grandma's willing to sell it to you for $50,000. Okay, great. And let's say that the bank said, we're fine with this, but you got to put $10,000 down because of your credit or whatever the situation may be, and you don't have $10,000. Well, one way this would be attempted is instead of buying it from her at $50,000, well, you may buy it from her at $60,000 and have her gift that $10,000 equity. This would mean the contract would say $60,000. The seller would at closing get $60,000, but immediately on that same closing, $10,000 would go from her column to your column, or to the buyer's column. So from seller to buyer. And so this would then eliminate the need for down payment. Now, what about closing costs, taxes, and insurance? So using the same example, and let's say the bank says, that's fine, you covered your down payment, but now we need, $5,000 for closing costs, taxes, and insurance. So then maybe you rewrite that contract to say $65,000. $5,000 can be shown as paid closing costs by seller, so that's not part of the gift itself. And then $10,000 would be the gift of equity. So even though the seller's selling it for $65,000, at closing, $5,000 will go to the buyer's closing costs, taxes, insurance, and then $10,000 for the gift of equity, thus netting the seller $50,000. Obviously, there might be some title fees or other costs that you'll have to manipulate your numbers on, but this would allow you to move forward. Now, let's say the same scenario, but you talked to the bank and they said, hey, if you want a lower payment, you put 20% down and it'll make you not have what's called mortgage insurance. Typically, that's not an FHA style, that'd be a conventional style. FHA is going to have mortgage insurance regardless, but if you went conventionally and you put 20% down, you don't have to pay mortgage insurance. Now, not all lenders have mortgage insurance. Some local lenders like credit unions and other stuff may not, but they may have higher rates. But most larger banks or mortgage brokers are going to deal in Fannie Mae or Freddie Mac backed products. So they'll have a mortgage insurance requirement whenever you purchase a home going conventional as a conforming normal loan when you put less than 20% down. So what we may do is we may look at the numbers and say, okay, what would 20% be? We might have to guess just to make this easy math. Say, what if I bought it from grandma for $70,000? That would be 20% down, which is $14,000, which means she would get $56,000. And maybe she pays $6,000 of my closing costs, taxes, and insurance, which might be the case because insurance might be higher on a $70,000 loan than it would be on a $60,000 loan, even though many times it's not different because it's still going to be based off the $100,000 value of replacing the property. But the point is I would adjust my numbers upward to make sure that my grandma still got her $50,000. I've got my down payment covered by my gift of equity. And I've got my closing costs covered, so I can do a zero down, zero move in, not hurt my grandma, and really help myself. All right, sounds pretty cool, not bad. Now, how much can she give? Well, the easy answer is she can give $15,000 per relative in this situation without it being taxable. So let's say that you're the buyer, is married, then that means that grandma can gift $30,000, right? Without being taxed. Now, even if she gifted $500,000 of gift of equity, she still probably wouldn't be taxed because she has a lifetime taxable gifting amount capped at like 5.6 million. You have to look it up to get the exact number, but around 5.6 million per lifetime. So unless she's been giving away money left and right for quite a long time to all the relatives, she's going to be pretty cool with this gift of equity, and this should work out. Now let's talk about another idea. Okay, what about repairs? Okay, what if the lender has repairs? Okay, if the lender has lender-required repairs, basically what's going to happen is, depending on the lender, they may require those repairs be done up front, but let's assume they are. Let's go that avenue first. So let's say the lender says, you know what, you're going to have to replace this roof or we're not doing the loan, and you have to do it prior to closing. Okay, that might be a little tricky. Obviously, that situation would be a variety of techniques, from raising the sales price and having it paid at closing, or if I'm using the gift of equity method, maybe I'm basically going to pay for it as the buyer and then get that money gifted back to me at closing. Maybe that would work. But normally, if at all possible, I might set up an escrow, repair escrow, to be done after closing. So hopefully that'll work out to where if it's $10,000, for example, my bank will allow me to put that aside. So if I knew I was going to need that money, I would then say, hey, grandma, let's raise that price to $80,000. You pay 20%, which is 16 of that $80,000, leaving $64,000 net to you, $10,000 for the roof, and maybe now only have $4,000 for closing costs and prepaids. And obviously you tweak the numbers to be perfect and make sure everything works out. But that would be my normal solution for the repairs. There's other solutions, but that gives you a normal one. Also, for all my property flippers out here, here's a property flip tip. If you could find a home in a neighborhood where one of your relatives are willing to live, a great technique would be to purchase a bad property, fix it up, and sell it to them. This would allow you to gift the equity in the property, which say, well, I'm trying to make a profit. Why would I do this? I would want to sell it for more. Well, one, you're not getting taxed on it, so you're helping a family member out, so that's amazing. But number two, you oftentimes then could sell it at max value instead of negotiated market value, work around some repairs or less than perfect issues, and generate nearly the same income. And more importantly, you might be able to avoid at least one real estate agent, maybe two agent fees in the scenario. So it's definitely something to consider. If, for example, I bought a home for 50 grand, I put 20 grand into it, and it was worth 100 grand, I would maybe sell it and gift the down payment of 5-6 grand of equity to my cousin or relative that's allowable, and maybe pay his closing costs. So I may only get 90 grand, but if I didn't have to pay any realtor fees or less realtor fees, or even if I really want to help my realtors out and pay them the full fees, at least it sells quickly and right away and is more of a guarantee because my buyer is getting it with a special provision that they couldn't get it elsewhere. Anyway, I'm sure there's a bunch of cool tips and tricks that you can get and you can analyze and work on. I've done this several dozen times. I was surprised the other day when another agent said they'd never heard of it and another lender said they'd never heard of it. So I thought I'd put this out here for you. So pro tip number 37. So please, when you get a chance, tap the like, tap the subscribe, message me if you have any questions or details. This is Dante Pro Tips. I look forward to talking to you next time.